Have you ever heard someone recommend ETFs while someone else says mutual funds are a better choice? If you've wondered what the difference is, you're not alone. The good news is that both can be excellent investment options. Neither one is automatically better than the other. The right choice depends on your financial goals, your investing style, and how you plan to build your portfolio. To understand the differences, let's first look at what they have in common. Think of them like two different types of grocery baskets. Instead of buying just one apple or one orange, you're buying an entire basket filled with a variety of fruits. Investing works much of the same way. Rather than purchasing shares of a single company, both ETFs and mutual funds allow you to own a collection of investments with one purchase. That collection may include dozens, hundreds, or even thousands of stocks, bonds, or other securities. This is called diversification, and it's one of the simplest ways to reduce investment risk by spreading your money across many different holdings instead of relying on one single investment. So while ETFs and mutual funds are structured differently, they both provide investors with broad diversification. One of the biggest differences between the two is how they're bought and sold. An ETF or exchange-traded fund trades on a stock exchange just like an individual stock. If the market is open, you can buy or sell shares throughout the day, and the price fluctuates as the markets move. A mutual fund works differently. Mutual funds are priced only once each trading day, after the market closes. Whether you place your order in the morning or late in the afternoon, everyone buying or selling that day receives the same end-of-day price. For many long-term investors, this distinction doesn't significantly affect their investment strategy, but it's one of the key differences between the two. Another important consideration is cost. Many ETFs are designed to track a market index, such as the S&P 500. Because they're typically passively managed, they often have lower operating expenses. Those lower expenses are reflected in what's called an expense ratio, the annual cost of owning the fund. Mutual funds can also have low costs, particularly index mutual funds. However, many mutual funds are actively managed, meaning professional portfolio managers research investments, make buy and sell decisions, and often adjust the portfolio over time. That active management generally comes with higher fees. Of course, higher fees doesn't necessarily mean higher returns. Sometimes active management outperforms the market, and sometimes it doesn't. Minimum investment requirements are another area where the two can differ. ETFs are generally very accessible. You can often purchase a single share, and many brokerages now allow investors to buy fractional shares. Mutual funds have traditionally required minimum initial investments, although many fund companies have reduced or even eliminated those requirements in recent years. Today, both investment options are more accessible than ever for individual investors. There's also an important difference when it comes to taxes. Because of how ETFs are structured, they generally produce fewer capital gains distributions. Mutual funds, particularly actively managed funds, may distribute capital gains to shareholders even if the investor hasn't sold any shares personally. If your investments are held inside tax advantage accounts like IRAs or 401ks, this distinction is often much less important. So which one is better? The answer depends on your individual circumstances. If you value lower cost intraday trading flexibility and greater tax efficiency, an ETF may be a good fit. If you prefer automatic investing, active professional management, or are investing through an employer-sponsored retirement plan, a mutual fund may be more appropriate. In many cases, investors choose to own both. The most important decision isn't necessarily choosing an ETF over a mutual fund, it's selecting investments that align with your long-term financial objectives. While understanding the differences between ETFs and mutual funds is important, your long-term success as an investor is typically driven by factors like saving consistently, maintaining a disciplined investment strategy, and staying invested through changing market conditions. If you'd like guidance on building an investment strategy that's right for you, contact Semper Fortis Financial at 843-877-6718.